The Fed will bend till it breaks. In today's video, I'm going to make the case that the market lows are not yet in, that there is a capitulation sell-off ahead, but that this will not be the time to panic sell. In fact, now is the time to be watching and waiting to buy good quality companies that will potentially be available at prices you won't see again for many years. The problem, as always, is that it won't feel like that at the time. It will feel like prices can only go lower, that you'd be mad to buy in when things look so bleak, and that your money is better off in cash, term deposits, or anywhere but stocks. But that will be the emotional part of your brain talking. The trick is to recognize this at the time and put a gag on it. The role of your emotional brain is to provide you with short-term comfort. The role of your rational brain is to ignore it. Before I get into why there is more shorter-term pain ahead, a quick, but related, digression to what is happening on the ground right now in the world's biggest economy. FedEx Corporation, the global freight and logistics company, reported much weaker than expected results for the 3 months to 31 August on Friday in the US. Its share price plunged 20% on the news. FedEx's CEO, Raj Subramaniam, said, "Global volumes declined as macroeconomic trends significantly worsened later in the quarter, both internationally and in the US. We are swiftly addressing these headwinds, but given the speed at which conditions shifted, first quarter results are below our expectations." The global economy is slowing sharply, yet central bankers worldwide continue to focus on lagging indicators like inflation and unemployment in making policy decisions. With this in mind, the Fed meets this week to decide on interest rate settings. The view is that another 75 basis point tightening is almost certain, and there is some talk the Fed could increase rates by 100 basis points. The 2-year bond yield is a good proxy for where the market thinks the federal funds rate could go. It's currently trading at 3.86%, with the funds rate currently at 2.25 to 2.5%. The market is pricing in another roughly 150 basis points of tightening. Who knows whether that comes in 2 times 75 basis points or some other combination in the months ahead. But the point is the market expects more tightening, despite visible signs of a sharply slowing economy. The upshot of this is that financial conditions are at their tightest in years. As a proxy for this, I look at the real US long-term average interest rate. On Friday, it hit 1.41%. I know that doesn't sound too high, but it last traded at these levels back in 2011. The reality is that a highly indebted, highly financialized economy cannot handle sharply rising real interest rates. As real rates rise, it puts pressure on asset prices. You're seeing this at work in the price of 2 major global assets or currencies, the US dollar and the gold price. Check out the US dollar index. This charts the performance of the US dollar versus other major fiat currencies like the euro and the yen. Since mid-2021, the US dollar index has been on a relentless rise. This roughly coincides with the rise of real long-term interest rates, from a low of nearly -0.5% in July 2021. This is an indication of tightening global liquidity. Make no mistake, a sharply rising dollar is not good for the global economy. As the Wall Street Journal reports, the US dollar is experiencing a once-in-a-generation rally, a surge that threatens to exacerbate a slowdown in growth and amplify inflation headaches for global central banks. The dollar's role as the primary currency used in global trade and finance means its fluctuations have widespread impacts. The currency's strength is being felt in the fuel and food shortages in Sri Lanka, in Europe's record inflation, and in Japan's exploding trade deficit. The flip side to a rising US dollar is weakness in other currencies. That makes imports of global commodities, which are all priced in US dollars, more expensive. This, in turn, puts pressure on inflation and economic growth. Check out the Chinese yuan versus the US dollar since the start of 2021. From the Wall Street Journal again, China's central bank has attempted to shore up the yuan by releasing more dollar liquidity into the market. It has cut the amount of reserves banks need to hold against their foreign exchange deposits and has consistently set the daily fixing, a benchmark point for the currency, stronger than market expectations. Such dire condition points to a low in price, but it all depends on real rates and how much higher they can go before something breaks. That could be an emerging market currency crisis or a stock market panic liquidation. I have no idea, but I do know that global stock markets have been remarkably sanguine about the effect of rising inflation and interest rates this year. And while I think you have seen the worst of the inflation spike, central banks are likely to over-tighten and cause some real pain in the months ahead. That's why I think new lows await. One of the conditions you want to see for a final low is a spike in the VIX. You simply haven't seen such a spike in this 2022 bear market. This chart shows the VIX over the past 5 years. That big spike was the COVID panic in 2020, which was a low in the market. Volatility has certainly picked up in 2022, but there hasn't been a major spike higher. At the recent stock market low in June, it hit just over 30. That's an elevated reading, but by no means in panic territory. But with the Fed set to keep raising rates and quantitative tightening now running at a monthly rate of $95 billion, I can't help but think a panic lies ahead. I simply don't see the Fed engineering a soft landing. Monetary policy acts with a lag, yet the Fed continues to tighten into a surging US dollar, an inverted yield curve, and on the ground evidence of a sharply slowing economy. They will continue to bend the economy until it breaks. And that will be the time to buy.